Have you ever felt lost looking at a chart full of colorful lines? The price goes up, down, makes a jump, then drops all over again, and sometimes there seems to be no logic at all. Now imagine there were a guiding line, a way to clear the noise and see more clearly where the price is heading. Well, it exists. It's one of the most widely used tools by traders worldwide, and its name is the moving average. But let's be honest, most people use this tool the wrong way, and that's why today I'm going to show you how to use moving averages the right way to analyze the market, make better decisions, and yes, protect your capital. Welcome, I'm Chad Vermillion from the Zero Markets team, and if you're here, please don't forget to subscribe and stay updated on content that truly helps you understand the market. Back in 2017, I was just getting into technical analysis. A friend invited me over, I opened a NASDAQ chart on his laptop, and then he said, see this line here? That's the 21-day moving average. When the price crosses it, you buy. When it crosses below, you sell. So I thought, wow, this is easy. Why didn't anyone show me this before? So I tried it for myself, and it turns out, of course, it's not that simple. What he didn't tell me, and almost no one explains, is that there are several types of moving averages. Each serves a different purpose, and if you use them incorrectly, you could enter too late, exit at the wrong time, and take big losses. Let's break this down together. A moving average is, as the name suggests, the average price of an asset over a specific period. Imagine you take the last 10 closing prices of a stock, you sum them up, and divide by 10. That's the 10-period simple moving average. It forms a line on the chart, and this line shifts as the price evolves. Here's where people get confused. There's the simple moving average, the exponential moving average, and the weighted moving average. Each one weighs prices differently. For example, the exponential gives more weight to recent prices, making it more sensitive to market moves, so it's widely used in day trading. A 200-point moving average, for example, is much slower. It's used to spot long-term trends. But here's the real kicker. A moving average alone is not magic. It needs to be combined with context, with volume analysis, time frame choice, and overall market reading. Let's see this in practice. Take a look at a Bitcoin chart. If you plot a 50-day moving average, you'll notice that it often acts as a respect line. Several times, price drops, touches the line, and then bounces up again. It's as if the market is saying, okay, this is a buy zone. But then suddenly, price breaks below that line with heavy volume. What does it mean? The trend could be changing. In other words, the average now acts as resistance, no longer support. This kind of reading is what separates an amateur trader from a seasoned one. Pay attention to these common mistakes: using the wrong average for the wrong time frame, trading intraday with a 200-period moving average. You'll always be late. Not combining with volume analysis. If price crosses a moving average but volume is low, watch out. It could be a trap. Thinking moving average crossovers are automatic entry signals. They're not. Crossovers are just alerts. The real decision comes from full market reading, ignoring the specific asset. Each asset class has its own personality. A moving average that works on Amazon stock might fail completely on Forex or futures. Strategy without context is just guesswork. Think of a moving average as your GPS. It shows where you are in the path you've taken, but it doesn't predict potholes or traffic jams. It helps you make decisions, but shouldn't be your only guide. It's like driving in fog. A moving average is like low beams. It gives you better visibility, but doesn't solve everything alone. That's why professional traders combine moving averages with other indicators such as RSI, MACD, volume analysis, and price action. Remember, a moving average is not a magic formula. It's a contextual tool. It can help a lot, but only in the hands of those who know what they're doing. So tell me, have you used moving averages before? Which type do you usually use? Or is it clearer now how they work? Comment below. And if you want more hands-on videos with real tools from people who live the markets, subscribe to the Zero Markets channel. See you in the next video.